Hi, it's Tuesday, April 21st, and this is your market update from your team at Morton Brown Family Wealth. This week we had another historic move in an aspect of the markets when we saw oil prices decline into negative territory for the first time. What does it mean when the price of oil for delivery in May declines to negative $37 as it did this past Monday? It means that the demand destruction that we're seeing from shutting down the economy in response to the coronavirus is starting to ripple through to different aspects of the economy. So let's talk about yesterday specifically. What happens in an event like this and what caused that decline is that oil is still being pumped out of the ground, still needs to be stored, and we're running out of some of the storage to keep that oil until demand increases. There are no planes in the air, there are very few cars on the ground. We're not using nearly as much as we used to because activity has stopped. So what ends up happening is instead of someone buying what you are selling, you in turn have to pay them to take off of your hands your inventory. In the case of something like milk, where we also have an overabundance right now, farmers are dumping that milk just to maintain the right balance between supply and demand. We can't do the same thing with oil. We can't just dump it and leave it be without significant damage. So it creates a situation where storage is at a premium and you end up having to pay someone to take it off of your hands, hence negative prices. Let's put this in the context of prices in general. Inflation, deflation. This is what matters to us as investors in the long run, because if prices are going up too much or down too much, that can be a big challenge. Stable prices, according to the Federal Reserve, are about 2% inflation per year. That's a nice, steady growth. It means that there's optimism, that we can buy things today knowing that they're going to be worth a little bit more tomorrow. And there's a reason for us to buy it today because the things that we want to own are going to cost more next year than they did this year. The opposite of inflation is deflation, and that's what we've seen in the oil market. And you can see how it turns into something pretty catastrophic pretty quickly and is not as desirable. Because if I think that the thing I need to buy is going to be worth much less a month from now, 6 months from now, a year from now, I'm going to hold on to my cash. I'm not going to pay it, and it just causes a clampdown in economic activity. This is what the Federal Reserve and Congress are trying to do with a lot of their dramatic actions in the last month, is make sure that we are effectively keeping the economy inflated at the right times to bridge us over to the point where we're on the other side of this crisis. Some people have expressed concerns, as they did during the great financial crisis, is the Fed going to overshoot and create runaway inflation because they've lowered interest rates down to zero if we'd infused a lot of cash into the system? That doesn't seem to be the Fed's concern right now. Their bigger concern is deflation of the likes that we saw in the oil market yesterday, where demand completely collapses and there isn't enough cash moving through the system to keep the economy afloat. I think they're willing to accept some overshoot on the inflation side sometime down the road, because the real urgency is keeping that steady inflation, keeping prices intact and price stability where it needs to be. So I hope this is helpful to put the oil crisis in the context of inflation and deflation. If you have any further questions, you can reach me at dmorton@mortonbrownfw.com. Our team is ready and able to serve, and we hope you're doing well. Stay healthy, stay safe.